How to calculate your cost basis in real estate. Most real estate investors don't understand that they're overpaying in taxes. The reason being is they don't understand cost basis. Get this wrong and you can overpay in taxes by thousands. So watch this video and I'll show you how to not make that mistake. A lot of investors think that cost basis is just the price that you pay of the property. Yet they're missing out on some key expenses that can dramatically decrease their tax bill. I'll show you why most people overlook this. Want to keep more of your hard-earned real estate profits? Understanding your cost basis is the first step to help lowering your taxes and generating higher returns. By the end of this video, you'll know exactly how to calculate the cost basis on your real estate investments. This way you can minimize tax, maximize deduction, and avoid costly mistakes. What is cost basis in real estate? It sounds complicated, but it is really simple. The cost basis is simply the total cost you've invested in a property used to calculate capital gains when you sell. The higher your cost basis, the lower the taxable profit. The biggest misconceptions about cost basis. Many investors think cost basis is just the price they paid for the property. In reality, it includes all the acquisition costs, the closing costs, all the capital improvements you made over the years, and this changes that cost basis, increasing it over time. So what is the formula? How do you calculate the cost basis? Well, first, it's your purchase price. That is the base of the formula in the start. Second, you add back any closing fees, so lender fees, title fees, attorney fees, anything to close the property, any cost is added on top of the purchase price. Next, add renovations, capital improvements, any major repair. Now, this isn't a small repair and maintenance. This is a major improvement to the property. You're going to add that as a capital expenditure, and that increases your cost basis over time. This doesn't have to be at the beginning of the investment. This can be any time during the life of the investment. But if you capitalize that expense, that adds to your cost basis. And lastly, any demolition for development. That also would be considered an improvement, and that would add to your cost basis as well. If you do have commercial property, any improvements to the infrastructure, the water, the sewer, the power, the roads, those also are long-term capital expenditures, and that would add to your cost basis as well. So what is not allowed to be included in your cost basis? Regular maintenance and repairs. This is fixing toilets or small repairs around any property. Typically under $1,000 or $2,000 does not increase your cost basis. It's expensed in that year of a deduction for taxes, and that wouldn't add to your cost basis. Homeowners insurance is not included. Your typical operating expenses do not increase your cost basis. Adjusting your cost basis over time. How depreciation affects the cost basis. Owning any commercial or residential piece of real estate requires you to depreciate part of the property. This is something the IRS allows us to do and actually forces us to do. Depreciation reduces your cost basis. Each year you depreciate the property, it lowers the basis over time, which in turn increases your capital gains when you sell. Major improvements increase the cost basis, reducing your capital gains tax when you sell. And if you are 1031 exchanging or inheriting a property, this changes your cost basis, and that's a different video in the future we'll talk about. So here's the formula. How to calculate your adjusted cost basis when selling. Essentially, you want to know what this cost basis is so you know how much tax you're going to pay when you're selling a property. It's important to know this formula because you can make the right decision. Is it good for you to sell or not? So here's the simple formula. Take the purchase price of the property, plus any closing costs, plus any capital improvements, minus depreciation. This gives you your total cost basis in the asset. And then when you sell, you take your sales price minus any closing fees, and that is your adjusted gross sales price. Minus that from your cost basis, and that is your capital gain. That is the number you'll be calculating your taxes on after you execute the sale. Once you execute the sale, you will be calculating at least 20% long-term capital gains as long as you held the property for a year and 1 day, and then also the depreciation recapture. This is taxed typically at 25% versus 20%. We'll get into depreciation recapture in a future video, but this is helpful for you to understand what will be the tax rate on my taxable gain. Now, don't forget state income taxes or state capital gains taxes when calculating your capital gains as well. This is added on top of federal taxes, so it's something that's important that you're aware of, especially if you're in California. That could increase your taxes by at least additional 13%. Knowing all this helps you plan ahead, strategize for if you're going to sell or not sell, and make the right decisions for your investments in the future. Now that you understand cost basis, the next step is understanding the best tax strategies for real estate investors. Click here on my next video and I'll show you how to legally defer or not pay taxes and maximize your real estate profits.